Our topic today is thoughts and ideas on accounting for responsibility and responsible investing. And our principal goal, other than having a great discussion, is to tease out areas for further research and gaps in education on this topic. My name is Richard Spencer. I am the Director of Technical Thought Leadership at the Institute of Chartered Accountants in England and Wales, ICAEW, and I am the moderator for this session. We have a wonderful lineup of experts who are going to share their reflections on this subject from a number of different perspectives. So let me introduce your panel. We have Alan Willis, a Canadian chartered accountant, an independent researcher, writer, and advisor. We have Greg Rogers, founder of Eratosthenes. We have Alan Teixeira, Global Director of IFRS Research at Deloitte, UK. Nick Rydausch, Director, Lead Better Business Reporting, CFO Advisory, KPMG Australia. And finally, we have Alan McGill, partner at PwC. And finally, we have Jeff Hales, the Chair of the Sustainability Accounting Standards Board and Professor of Accounting at the University of Texas. Who would have thought, even 2 years ago, what a dominant subject this would now be, what a mainstream subject all of this would now be, and stretching well beyond the limits of sustainability. I'm going to go directly to our panel, and Alan Willis, I'm going to start with you. I think you have the hardest job today. You're setting the stage for us. Have we, do you think, and what are your reflections, but have we arrived at a new paradigm for business with a broader conceptualization of value creation?
Thanks, Richard. Well, we certainly have. We're living in very interesting and exciting times, as we all know. Let me just say this. I have said for some time that a fundamental transformation is occurring in the role of business in society. Never foreseen by 19th century drafters of corporate law, unimaginable just 50 years ago. An unprecedented and accelerating wave of global trends and issues has emerged over the last 4 decades or so, with sweeping business implications. Companies are having to respond to urgent environmental and social issues of global scale, climate change being number one, of course, which impact business models, supply chains, strategy, and so on. They're also having to anticipate and deal with megatrends such as urbanization and population demographics, and with what is being called the fourth industrial revolution. This is the new wave of smart digital technologies such as artificial intelligence, cloud computing, big data, and the internet, fundamentally affecting consumers, products, marketing, and the like. Responses of business leaders to all these issues and trends are calling for a fundamental rethink of business purpose, accountability, business models, and value creation, with alignment as necessary with things like transition to low carbon economies or the UN Sustainable Development Goals. Leaders and laggards are increasingly differentiated in the marketplace by their focus on resilience, innovation, and trustworthiness, and by the millennials and Generation Z, who are not only today's most influential consumers, employees, and citizens, but also tomorrow's business leaders. Now, in such a fast-changing 21st century business landscape, financial accounting no longer suffices to provide the information needed, either for internal decision-making and sound governance, or for external reporting to investors and other stakeholders. We're seeing the constant emergence of new performance measures and impact indicators, methodologies for measuring natural, social, and human capital, approaches for measuring intangibles such as intellectual capital, and various frameworks and standards for sustainability and value creation reporting. My panel colleagues will tell you more about these pioneering and multidisciplinary developments, many of which are occurring outside companies' finance and accounting functions, often devised by innovative think tanks and firms and researchers. So accounting for sustainability, or accounting and sustainable value creation, is becoming the urgently needed 21st century of business and capital markets, 21st century language, I would say, of business and capital markets. The language of business is changing. And I also might say later on in the session that if accountants and accounting are to play a meaningful role in all this broader space of business information and reporting, then accounting education, curricula, competency maps, courses need to undergo profound redesign, not just fiddling at the fringes, but a basic rethink. So I'll leave it there for now, Richard, and let's go ahead.
Wonderful. And actually, I mean, there's so much going on there, isn't there? So if you had to pick one or two, what do you think are the most pressing? If we had to sort of prioritize here, where should we focus?
I think out of all these issues and trends and things we're having to focus on and deal with, I ultimately think that the sustainability issues, living on a planet within planetary limits, doing business within planetary limits, and dealing with societal issues which are never been more serious. I think the environment, social and sustainability issues, for me, are number one, ahead of everything else. Never mind all the various industrial revolutions we have. I think right now in this century, saving the planet and society is number one priority, and business absolutely has to be in there.
So not unlike, as others have characterized it, that there's a sort of triple crisis of climate emergency, massive biodiversity loss, and massively growing inequalities. That kind of, and I'm probably a question I'm going to come back to with all of you, but just at that high level, what do you think the role of the profession is in all of this?
I think the role of the profession partly is to rethink the whole function of finance in companies. The profession certainly has to be dealing with assurance and credibility and trust. But I think the fundamental thing is for the profession to be very actively engaged in rethinking what accounting is all about. Our legacy from Pacioli 500 years ago is all very nice with the double entry bookkeeping and the focus on financial accountability just to shareholders. But the game has changed, and now businesses realize that they need to be accountable for a great deal more to a great many other kinds of categories of society. And I think the profession has to be at the middle of this, but not trying to catch up or play on the fringes. The profession has to lead the way in rethinking what our profession is all about.
That's terrific, thank you. So to go from that 30,000-foot view, then right down to the view right at the ground, I want to move on to you next, Greg, and thinking in particular, and making this very particular, thinking about the model you've developed and the concept you've developed around the carbon quotient, providing us a clear and straightforward way of measuring climate-related transition financial risk and to track that institutional performance. Do you want to talk to us a bit about your model, but also to think about some of the principal barriers and constraints that we're going to face in achieving this magic idea of net zero? Indeed, what does net zero mean? I've pumped a lot of questions out to you there, Greg, but do you want to talk to that?
Yeah, sure, Richard. Let me start by following on something that supports what Alan said, which in a recent panel discussion, both the current and the former dean of the Judge Business School at the University of Cambridge said climate change is the biggest challenge facing the global economy and society, biggest long-term challenge. I think that indicates to me that climate change has really gone mainstream. The panel discussion by the way, was about the future of business schools and the roles that business schools needed to play in this transition. I think we're well past time that we need to integrate carbon risk, climate change into our mainstream frameworks for internal financial planning and external financial reporting. So that's what I've been working on, just so the audience knows that's what carbon quotient is. Let me take just a few moments to describe it, how it works. And hopefully, Richard, I'll work in those constraints and barriers into the discussion. CQ, for short for carbon quotient, has 3 steps. The first step is to monetize current, future, and past emissions in order to create carbon-adjusted pro forma financial statements. So that has 3 substeps. Start with the income statement. We're going to monetize or price carbon emissions, realized carbon emissions from the current year at approximately the cost that it would take to remove those emissions from the atmosphere. I think of it this way, that I think that we, in the scenario that we are in a net zero framework today, in which by law, companies are required to offset all of the carbon emissions they're responsible for that go into the atmosphere, that they have to pay to take those back out. So obviously that's not the law today, but that would be the scenario that we're working from. So to answer your question about net zero, the basic idea is not that that we can't put carbon emissions into the atmosphere, but if we do, we're responsible for taking them back out in some way or another. The second step starts to move on to the balance sheet, where we create a contra asset for the unrealized carbon emissions that are embedded in a company's long-lived tangible asset base. So we monetize those at, let's say, $100 a ton, and we're creating a unrealized emissions expense that can be viewed as a contra asset to the property, plant, and equipment that's on the balance sheet. I think of this as the future that has already happened. So we've got huge investments in assets, trillions of dollars in carbon intensive assets that have to be either retrofitted or replaced if we are to get to net zero. And I think that is the fundamental challenge of net zero. The constraint is that companies have to do this while remaining profitable. That's going to be extremely difficult and risky for corporate managers. The third element and the second element of the balance sheet is to create a contingent liability for cumulative past emissions. Okay, looking backwards, pick a time in the past where we want to start, but the idea is that these emissions that went into the atmosphere in the past may have to be compensated for in the future. You could think of it as a court award for unjust enrichment, for having a company having profited from harming society in the past. So that creates a set of pro forma carbon adjusted financial statements. The second step is to create a normalized ratio that allows you to compare different capital investment opportunities, regardless of the asset class. Going back to that fundamental challenge and constraint of net zero, the ratio I'm using is unrealized carbon expense, so that contra asset that we created, and then divide that by the carrying value of a company's property, plant, and equipment. And what I didn't say earlier was that calculating this unrealized emissions, you could do this based on an algorithmic calculation of the average remaining useful life of the assets. Okay, so think of this ratio with unrealized carbon expense divided by the carrying value of property, plant, and equipment as a burden on assets that would be a companion to, say, return on assets. So the point is that ratio is reflecting the impairment risk that's embedded in these long-lived carbon-intensive assets. All right, the final step is that we need to track performance over time. So the idea is start wherever you are as a company, calculate your carbon quotient, which is going to be obviously much higher for oil companies than it is going to be for tech companies, and create a downward sloping curve towards zero. If your target is 2050, you get to zero by 2050. If you're electric utility company, maybe your target is 2035. So you start then mapping your carbon quotient performance in the past and projected future performance as compared to that downward slope. The idea is that in a net zero world, it's not just oil companies and coal-powered utilities that have to get to zero. We all have to get to zero. And so we all have a common destination, and we've also got a common deadline, which allows us then to measure everybody in a similar way. So I'll stop with that and answer any questions that folks have about it.
That's wonderful, Greg. And I think the beauty of much of that is that it kind of works within the conceptual framework as it exists. you're not sort of seeing a wholesale adaptation of accountancy to do this. It's within the existing tools. But just briefly, because I know we're pressed for time, but what do you see as at the macro level, the economic barriers that need to be that might throw themselves up here?
So I see the fundamental problem is that the risks are asset impairment, asset stranding, and asset replacement. And in all of the forward thinking about transition pathways to net zero, the economists are looking at replacement costs. And generally the assumptions in any of the studies that say we can actually do this, that we can achieve this objective, they're talking about immediate commencement of asset modification and replacement. If we don't do that immediately, it's going to get harder and harder over time. So I think the fundamental challenge and the economic constraint that's global is that we have to replace an enormous built infrastructure of carbon intensive assets. And that is not going to be cheap, easy, or fast.
Thank you very much. So moving on to you, Alan Teixeira. The markets need, of course, high quality, timely, useful information. And one of the things we've kind of seen in the last year or 2 years, 3 years, the landscape of non-financial reporting evolving rapidly. If better information is needed for investors around how businesses are applying climate change issues and other problems, do we need global standards for that? Is that even achievable?
Yeah, well, I think as Alan said, there's a lot has been happening over the last few years. There are different frameworks being developed. And if anything, I think it's a really confusing landscape. If you're a company, you're sitting down there and you're saying, right, I know I'm getting a lot of demand from investors to provide information that's helpful so they understand my business model, how I'm both affecting the climate, for example, in terms of the way I'm behaving, and also how the climate is affecting my business and how I plan to respond to that. So getting back to Greg talking about stranded assets, that's the climate having an impact on my business. And I think if you sat down and said, right, where do I start? It's quite hard because there are lots of frameworks. There's integrated reporting that picks up a lot of these aspects. Jeff's chair of the standards board for sustainability standards. So there's some metrics there that we can have. There are initiatives in Europe, in New Zealand, for example. They're trying to develop standards. They want to be world leaders in this type of reporting. There's a whole proliferation of different things going on. And it's like if you go back 20 years in terms of just financial reporting, the whole idea of the International Accounting Standards Board was to get comparability. So we can compare across countries and within the same country because they're all applying the same standards. So I think at a very starting point, yes, the answer is yes, we do need global standards. If anything, we need to try and rationalize the framework we've got. We've actually got a ton of information out there and lots of really, really good work that's gone on into developing requirements, but there's just so much of it. And the good thing is that the IFRS Foundation, which is basically the home for the International Accounting Standards Board, has got an initiative to try and establish an International Sustainability Standards Board, which is a funny sort of thing. They're going in a public consultation at the moment, but they've already signaled that they'll announce the new board in November, and they've also advertised already for its chair and vice chair. So it seems to be that things are in play for that. They have the structure in there because they're used to due process and to developing globally standards that seem to be reasonably well accepted in terms of financial reporting. So they can use that structure for that. The other really good thing about that is IOSCO is behind this as well. So you've got the International Securities Organization basically is also pushing for this. So I think there is a lot of goodwill to try and get to basically a core set of global standards to help. So when a company sits down and starts to write and report on what it's doing, it's going to do it in a consistent manner. So I can then compare, for example, an oil and gas company in the UK with one out of Brazil, or also tech companies and so on. So I think it's achievable. I think it's going to be really challenging because I used to work at the ISB and I know what it's like, that people always thought their standards were better and they don't want to give up anything. So when you go into global, you're going to have to, you've got people in the international integrated reporting framework and other frameworks. We can't all have exactly what they've got. It's the way it is with globalization. I think you have to try and find a consensus that we get to. The good thing is that if you get that consensus, you do get comparability. It's kind of like you've got your base set of rules. We know that whatever we do, other jurisdictions are probably going to basically put things onto the sides, clip things on, because they'll have particular preferences. But I think a core set of global standards is actually certainly achievable.
And thinking about how the reporting landscape, if you like, and just how rapidly it's been changing, particularly with the evolution of and demands for non-financial information. Where do you think the research opportunities are that particularly would benefit the investors and stakeholders and businesses?
Well, there's a lot of research, obviously, in financial reporting in terms of trying to understand whether or not you've got value relevant information being reported to investors. And we understand how the finances work, or mostly, not always the case, but we usually understand how those numbers work. When it comes to these non-financial things, it is actually really far more challenging, because I think if you look at the correlations between things like the way you are operating a particular way, and how that will manifest itself in terms of the financial statements, ultimately, it's a lot more difficult to look at those relationships. So I think there is scope for a huge amount of research in terms of trying to see, for example, the Sustainability Accounting Standards Board out of the US have got lots of metrics on that relate to climate, for example, and other aspects of sustainability, such as intellectual capital and human resources and things. Having a look and seeing whether or not that information, its relationship, I think, with future performance and future value creation of the entities itself, and also looking at the way that that investors respond to the way corporates report, for example, because we see a lot of talk around about how investors are very conscious of their investment portfolios at the moment, and I think it's $70 trillion worth of investment funds won't invest in tobacco products. And seeing these other metrics, you can actually start to see how corporates are behaving in terms of their plans for trying to get to net zero, and whether or not that actually affects investment decisions. So I think there are some really interesting opportunities for researchers in this.
That's terrific. Thank you. Before I come on to Nick, I wanted just to ask Alan McGill. So we've been thinking about a sort of almost a loop of information about Alan Willis outlined for us the challenges that we face, and Greg talked a bit about the granularity of decision useful information, and Alan Sarah's talked to us about how that goes into markets and things. Thinking about these challenges and this information from the point of view of your clients, what have you got some reflections on because this feels like a very abstract conversation in some respects. Bring us to the reality of what are your clients saying?
So look, Richard, firstly, thank you. And a great subject matter to obviously pick up on. And the first thing I'd say is that actually in all the client conversations that I have, whether they're here in the UK where I currently live or across the rest of the world, it's very clear to see that whilst the whole ESG subject matter is absolutely now becoming a top 3 business item agenda, all of those organizations and all of the corporates are absolutely seeing it, though, as a huge opportunity for their organization. And I think that's a fundamental change and a shift that's happened as well, because historically, I think a lot of organizations and corporates would have seen this as a sort of value at risk type engagement and discussion. How much of my organization might be impacted by changes in the climate? Are the availability of natural resources going to be around, and therefore am I going to have problems in manufacturing my product or delivering my service? And therefore they would manage to that effectively. But I think what they're now seeing is that there are these business transformations that are absolutely going to occur in every single industry across the landscape. And as a result of that, you're really seeing, I think, business leaders now stepping up to seeing that opportunity and that transformation. Yes, of course, there are pressures for them. Yes, you've got the regulatory requirements and the desire for further information, and you're hearing some of that already through what Alan T was talking about. Absolutely, as well, you've got the interest now, probably for the first time, from that investment community to really wanting to understand what businesses are doing in and around this subject matter, going way beyond now just using this type of ESG information for initial screening and thinking about, do I or don't I perhaps want to invest in this organization? And finally, you are seeing, I think now really for the first time, a shift in consumer behavior, a shift in consumer patterns, buying, wanting to be associated with brands and organizations that are absolutely operating and behaving in an environmentally and responsible and socially responsible way as well. And that isn't just about whether or not, therefore, they're going to put their hand in their pocket and pull out their pound or their dollar or their euro or whatever currency to buy that product or service. They're looking at companies now to say, do I want to go work for that organization, given the values that it has and what it's doing? So that transformation piece, therefore, I think for businesses is absolutely tangible. It's there and they can see it in front of them. But what those businesses are also going to have to do is basically learn to love and embrace the concept of transparency and openness. They're going to have to start to disclosing more and new information and content that they haven't collected before. And they're going to need to do that fast and quickly because they're going to want to be able to engage and move their organization forward. But as you heard in the last session there are absolutely problems and issues around the comparability of that data and that information. But those will be overcome. The standards will arrive, the standards will come out there, the measurement process will be there, but that doesn't mean that companies can't now start acting and developing and moving forward. And they are. They're not waiting for the regulation because they can see it's going to come. They've already started to take, advantage of those opportunities that are out there. They absolutely know as well that with the rise of a lot of these societal problems, and Richard, you mentioned the third one outside of climate change and biodiversity, absolutely the huge inequality issue that now exists. And therefore, again, organizations can see that they need to become and are needing to transition to become more purposeful. And purposeful organizations grow. Purposeful organizations last. People who are purposeful thrive. So these are the ingredients and the success ingredients, if you like, for which businesses are now, I think, really wanting to engage with and to demonstrate what it is they're doing. To do that, they need broader sets of information. They need good information, but it doesn't need to be measured within a micrometer level of actually the integrity of that data. It is important, but directionally companies know where to start and where to go. And they now are also starting to articulate what good looks like. I think a lot of what the corporates have done in the past has been around demonstrating how less bad they are because they've improved their performance from prior years, reduced the amount of perhaps waste that they've created, the number of accidents they might have had, the amount of carbon they've emitted into the atmosphere. The shift in society now is not wanting to see what less good looks like, but what does, less bad, I beg your pardon, looks like, but what does good look like now? Net zero is good. We are not polluting. I think the other transition that's happening as well for the corporates is the idea that netting off and conflicts and trade-offs is also now starting to move, to be moved away from. So just because I know as an organization that I do some damage over here, but because I do a lot of positive impacts in a different area, and that positive impact is greater than the negative, I'm okay as a corporate citizen now. That sort of behavior and thinking, and I think that very much picks up on, the carbon quotient piece around thinking about everything you're doing, is actually you can't have any bad impacts now. You need to understand how to move away from those, mitigate them completely, and move to positive impacts. Corporates, again, I think are really starting to understand that shift. And also it picks up, I think, on what Alan Willis was talking about earlier, around planetary boundaries and understanding how we all work and operate in that particular space so that we have a good economy, that we have good business, but we also have a stronger world. So huge opportunity. The corporates can see it. They've always been as well incredibly good at responding to opportunity, and this is a opportunity that is being absolutely signaled to all businesses about that need for transformation and the need for change. The final comment I'll just leave you with is that, again, if you believe, as a lot of the climate scientists do, that around the issue of climate change, we've got about a decade to sort the problem. The issue around that is, if you think about it carefully, every 5 weeks that pass is 1% of that decade's time gone. So businesses do need to move fast and quickly. The standard setters need to move fast and quickly, and the corporate and consumers will move fast to move towards organisations that are demonstrating how they're delivering on that.
I want a question to follow up with here, which is amongst we the sustainability, there's a sort of joke about what's the fastest thing on earth, and the answer is people becoming ESG experts. And I was it made me think about the skills that are needed in order to embrace this new future, and rather than just kind of asking the impossible, which is what skills are needed everywhere. But what about boards? What skills do we need to see on boards to see the tone from the top being right, to see the leadership, to see the right questions being asked?
So Richard, I think that's a really good question, because it brings into, stark, vision and view the effectiveness of governance. So how effective is this governance going to be around the ESG agenda on some of these big issues that corporates and society are going to be needing to answer and respond to? And at the moment, it's clear that there is just not enough people on boards with the right subject matter command or with the competencies that they need to really effectively challenge business, management, the organization, its strategy, where it's going, what it's looking to do, how fast it's going to do that over in terms of the way in which it's going to respond. So the way I think organizations need to address that particular issue is around what I might say is the 3 E's. They need to engage. They need to start engaging much more than they are, and they need to understand how to engage. To do that, they need to get better educated. They need to start understanding what they need to do. They need to look around to see what new skills do I need to bring in and onto that board to understand where I do and how do I ask those sort of questions. And finally, the final E is expand. In the sense of absolutely ensure that this is an issue that is addressed in every single aspect of the organization, across every part of the business, and embed it fully into it. Because again, I think if they do that, first of all, you'll mobilize the huge workforces that are out there for all organizations, small, medium, and large, around a subject matter. You will unleash a wave, I think, of innovation in organizations that'll drive businesses forward. They will become more productive. They will become better. And as a result of that, that competency level will rise. But it does need to go, rise very quickly. Based on the comment I last made about this, every 5 weeks that pass, that's 1% of time gone to do something in. So make each 5 weeks, really count.
Sorry, moving on to you now, Nick. Of course, in the whole system of things, trust is fundamental. Is the data I'm getting reliable and useful? What are the big challenges in building trust around reporting and disclosure?
Yeah, thanks, Richard. Yeah, as we've heard, we're entering into this 4th generation of business where technology and relationships are central to new business models, and the focus is on this long-term enterprise value creation. This requires new frameworks for management decision-making, accounting and reporting, which considers all the resources and relationships critical to that value creation, what the integrated reporting framework calls the 6 capitals. It's therefore important, as you say, this broader suite of business information is credible and trusted by the users, as well as rewarded in terms of ongoing access to and pricing of those required capitals. Therefore, the audit and assurance frameworks and the skills of assurance professionals also need to adapt to audit 4th generation businesses. As we heard, much is underway. There's growing action to create global sustainability standards to drive consistent measurement and disclosure, which is critical for assurance. The Value Reporting Foundation provides a multi-capital management decision support approach, integrated thinking, as well as the actual integrated reporting framework. As we heard earlier, they provide primary ESG measures by sector required by investors through the SASBs. There are a growing number of organizations applying the IR framework, and they're reporting both business benefits and market benefits from this action. And these benefits are supported now by academic research by the likes of Roger Simnet at New South Wales Uni and Mary Barth at Stanford, amongst others. But more academic evidence is required. And from a credibility perspective, auditors have started to provide assurance over these broader-based integrated reports or non-financial reports, not just on the KPIs, but are starting to actually provide assurance over compliance with the actual framework. We've done 2 integrated audit reports in Australia. And to tell you, auditing an integrated report introduces additional complexities that are broader in scope. And we're focusing on more forward-oriented information than we were in traditional audits and even in sustainability audits. As with financial audits, the audit must understand the business before planning. And also, the business must be ready for this broader assurance. The auditor needs skills to evaluate, test, and report on the effectiveness of controls over core business processes, not just financial processes, such as the governance framework, strategy development, risk and opportunity management, resource allocation and performance measurement, stakeholder engagement, as well as the integrated reporting process itself, including determination of what is material to report. It's important to understand that the auditor is not being asked to second guess those charged with governance and management on the quality and resilience of their business model or the appropriateness of their strategic direction, but rather is ensuring what is reported reflects what is actually happening in the organization, and that the disclosures made are materially complete and accurate. The audit team also requires additional experts in specialist areas, non-financial areas, particularly around intellectual capital, as we've heard, and also certain areas of human and social capital where current frameworks are very immature and the information is pretty ropey in many areas. There is early guidance from the IASB on auditing integrated and other non-financial reporting in their recent publication, Assurance over Extended External Reporting. And example 10 to this guidance has been further refined with IFAC to release an excellent short paper in June entitled Accelerating Integrated Reporting Assurance in the Public Interest. On the user side of the equation, users must reward the organization for this effort. If the audited integrated report provides a clearer and more credible picture of how the organization is creating sustainable enterprise value, will investors have the confidence to use this data to tailor future financial cash flows, improve the risk alpha, and even push out terminal values in their modeling? In conclusion, the move towards fourth generation business is well underway. Accounting, reporting, and assurance professionals now have the basic tools to manage, monitor, report, and assure on an organization's effective use of multiple capitals and delivery of sustainable enterprise value. But more is required, which provides opportunity for providers of executive and student education, as well as academic researchers. I've drawn out a number of these opportunities in this overview, but I'll go back to you, Richard, now for questions, and also Jeff to actually pull together some of those academic responses.
Thank you very much, Nick. A follow-up question for you perhaps you could think about what the business benefits of having an integrated report, or indeed assurance over material non-financial and reporting might be.
Well, I think in a nutshell, I mean, having done greenhouse gas auditing for about 15 years now, what we were auditing 15 years ago and what we're auditing now is completely different information. The information was very basic. So the critical thing is this is now investment grade data. So it needs to actually be, we're going to spend the money to actually implement new systems and processes for new business models. We're going to provide broader information, as Alan was saying, or Alan M was saying, to the capital markets to help them make decisions. We're going to be more open and transparent. That information has got to be credible. It's got to be what's material to value. It can't just be more waffle, because that actually, you lose the story, you lose the information. It needs to be stuff that can actually be used and modeled and actually assessed in the valuation perspective from a capital markets perspective. But also it needs to be broad and engaging enough and understandable for broader stakeholders to say, I want to work in this company, I want to buy from this company, I want to be associated with this company, etc. So the critical thing really is it's got to be investment grade data, and it has to be material and relevant to that new business model.
And how far are we with a lot of the non-financial information from the levels of assurance or audit that can be provided for financial statements?
A lot, yeah, a lot. I think the process of assurance is well understood, and delivering assurance. What we actually need now is the work we saw from Greg and others, is actually the academic and the robust, credible, supported frameworks or measurement frameworks and reporting frameworks to actually deliver that information effectively to the market, so it can actually be used and you can be rewarded for the effort. So I think it's an enormous opportunity.
Thank you, Jeff. We come to you, and really listening to a lot of this. It's kind of I think you can draw a lot of this together for us, because clearly the kind of purview of the professional accountant is just kind of expanding exponentially in all directions. Is the academy, are our universities ready for this? What's the state of accountancy education?
Thanks, Richard. I would love to say that the state of accounting academia is great, but I'm a bit concerned that that we're very late to a rapidly already departed train. In fact, when I think about what I see on campuses, the scientists on campuses have been studying, like they are the source of most of the information that we have around climate change. They've known about this for 30 years, probably more, and it's moved across campus into law schools, into public policy schools, into business schools, and it's moved into business schools in finance and marketing and in other fields, but for some reason, accountants have been quite slow, very slow to embrace the role that the accounting profession can play and the very important need for education around this. And I think that this lagging perspective that accounting academics have had is not independent of what I see as sort of an increasing crisis in accounting curricula. It is difficult to get students excited about accounting. Enrollments have been declining for some number of years at most schools, and it's a challenge to get students interested in that. And one of the things that breaks my heart is when I hear students who are trained in accounting come back from internships and feel like they don't know how businesses operate. They don't understand the things that they need to help the businesses to actually be successful. And so I think there's a big role to be played here by accounting academia, both in terms of research, also in terms of education. And some of these points have already been hit on. But just to put a point on some of them, I think of accounting as a profession as having a major role to play in facilitating a broader accountability than we've focused on in the past. I think accounting, traditional financial accounting, has done amazing work in helping companies to be more efficient in terms of their expenditures and to grow revenue. But oftentimes there's been a focus, almost a myopia, that surrounds quarterly or semi-annual or annual earnings per share, a highly aggregated number that just captures one dimension. But in fact, as has been mentioned, there's this fundamental shift that is happening, transformation in terms of like understanding from consumers, from investors, from policymakers, from society around how we want to hold businesses accountable for what they do, that their business activities have implications that are external to them, at least to their immediate finances, and that needs to be accounted for. And accounting as a profession has a major role to play in facilitating that, both from a market perspective of helping investors to get the information that they need to make better investments about, direct their capital toward the companies that are well positioned to build enterprise value over the long term, but also from a policy-making perspective as well, to help governments and markets be run in a way that is decided in a given region, but they'll need information for that. Accounting should be central to all of that, and none of it is around just reporting. It's really about decision-making about companies, but really fundamentally decision-making within companies. And again, accounting has a major role to play there in helping businesses understand the types of decisions that they need to make to be good stewards of the resources that they are overseeing. So I think there's a tremendous scope here for what needs to be done. Alan and Nick and others have mentioned the role for research here. There's a lot that we don't know. There's so much that we don't know, and we need to know. And so we want to know what are the key issues that need to be managed, generally for most companies, as well as specifically within given industries. We've heard references to the Value Reporting Foundation and to the work that SASB does, and that has been informed by research, but we need more and better research, continuing research, to tell us whether we've hit the right mark and what could be done to improve the topics that we've identified, what could be done to improve the measurements that we're using. I appreciate Greg's innovation with the carbon quotient, and so understanding what are the right topics, what are the right ways to capture certain issues, what are the best ways to bring that into decision making. That those are open questions that we need researchers to focus on. Accounting academics can put their time and effort and minds to that task, and we would benefit from it. And that can then feed back into the teaching, because we need to bring this into the classroom. We heard Richard, you mentioned, and Alan M had mentioned that we need new skills, new knowledge for the profession. My view on this is like, we don't need everybody to be a climate scientist, but we do need, from the way I think about this, we do need business professionals to be ESG aware, to realize what it is that they are going to be held accountable for. So to whom and for what? We have to answer those questions, and we need professionals to be aware of that. And that will make things more complex, as Nick had mentioned, for example, with respect to assurance, external assurance that we provide. It's different when you're assuring an integrated report, as Nick mentioned, than it is to assure a set of financial statements. But there's so much similarity there as well. So it's not that we need a fundamentally different process, but we do need an expanded or an adapted process that takes advantage of the skills that the accounting profession has for generations honed and developed, but then applied to a broader set of topics and issues, and with a different time horizon that is the focus. So just a few thoughts there, but I think there's plenty to be done. I would hope that my accounting academic colleagues at universities around the world would be racing to embrace the opportunities for adapting their curricula to help students to get what it is that they need to know, and frankly, I think what it is they want to know, and that will simultaneously be what we need as a society, but also what accounting programs need to continue to draw in students with excitement around what it is they're going to learn and the opportunities that there are to go out and apply that knowledge.
Right. Wonderful. That's wow. There's a lot there, and I think we're cruising into our last 10 minutes. So I wanted to just kind of put a question out there and maybe use it to get the reflections of all our panelists before we draw to a close. So I'm just going to randomly pick one of you to start with, and Alan McGill, you're at the top left of my screen. So just to start you off on your reflections, I've got a kind of a question here, which is what is the role, do you think, that we're preparing the next generation of accountants for?
I think the role for the next generation of accountants that we need to prepare them for is one that's around relevance. We focused for the last 100 years effectively for a financial accounting and auditors and accountants to become very specialist around being able to measure and report financial information. And some argue there's still a long way to go with that as well at the moment. But absolutely, the skills that they've developed, the understanding and the knowledge about how to record, information is absolutely transferable into these broader information sets. And if we don't do it, quite frankly, the profession will not be relevant because there will be the demand for this broader information. A lot of the discussion today has focused, and I've heard the word investor many, many times, but there are absolutely other parts of civil society that are going to want to see more about what organizations do, that broader value creation process. And we touched on it, and Nick mentioned, the different capitals. So actually the way in which we measure those, the way in which we account for those, the way in which we record those, I say that what I mentioned before about the love for transparency and openness is going to mean that we have to position the accountants in a different way to go forward, to have relevance and to still be of value and to be of use.
Wonderful, wonderful. Nick, let me come to you next. We've got about a minute or so each.
Okay.
No pressure.
No pressure. Totally agree with Alan. I think I think Mervyn King talks about the future CFO being the chief value officer. So being able to understand not only the financial implications of business decisions and how to actually communicate that to not just the financial markets but all stakeholders, but also those other underlying non-financial value drivers, which actually make up more of the value of the company, market value of the company, than what comes on a balance sheet. I mean, Ocean Tomo's research every 5 years on the S&P 500 shows that about 10% of market value of the S&P 500 is on a balance sheet. 90% is something else. It's actually associated with these other 6 areas of value creation. And so we need to actually get people excited, accountants excited and understanding about these new business models, about how to actually account for these multiple capitals and present that information to a broader stakeholder group to actually realize the value and of actually monitoring and managing scarce resources and key relationships towards a longer term sustainable value development. So I think that's the bottom line, is that's how you get them excited. That's what the new kids on the block want to do and want to learn about. And we've got to make our courses around accounting more about value and how to account for multiple capitals, and have the research work like Greg and others and the academics to support and give evidence underpinning the change and underpinning the value created for accountants or people doing these courses for long and exciting careers.
Wonderful, wonderful. Greg, what would you like to see the accountants of tomorrow be doing? What would be your pin-up accountancy person?
Well, so let me start with a couple of observations from my perspective. So just to state something that might not have been obvious, but there's really just two inputs into the carbon quotient framework. One is audited financial information. We already have that. We got great systems for that. The second one is emissions data, which gets extremely complex when we go from scope 1, scope 2 to scope 3. I think accountants need to play a role with that. I should do a call out to the GHG, the Greenhouse Gas Protocol. It's fundamentally an accounting framework. Financial accountants need to understand that. They need to get involved with it. They need to bring rigor to it in their organizations. So if that happens, if good audited financial information and good audited emissions data exists, carbon quotient doesn't really rely on anything more. So in other words, it can create an accountability framework for companies, whether companies like that or not. It can be published and it can be made available for 10,000 companies and 30,000 portfolios. So I think that will happen. And I think what that does, then it shifts the burden to the accountants that are inside organizations to, like Jeff said, use it for internal decision-making. I think of it like the carbon quotient is kind of like, at one level, it's like a football game. You need to know how you keep score in the game and who's winning and who's losing. Type to Alan M's point, that there's going to be competition, there's innovation, there's opportunities to get ahead of others. We need to know who's ahead in the race. But then to take the football example, it's not just keeping score, it's all the decision making that goes into a good strategy, into who the players are and to what the plays are called and how they play out. That is enormous opportunity for accountants to play a relevant role in the internal financial planning and decision making of their organizations.
Thank you. Alan Willis, you've been so patient. You started us off quickly. What do you see the accountant of tomorrow be?
Well, first off, let me say that Jeff and Alan McGill have already spoken to the issue of urgency. Accountants have really got to get going on this. We just can't take another 500 years to sort this out. We've got about 10 to 20 years to sort this stuff out. So that's gone. And then Nick, I think, mentioned the chief valuation officer. That's another line I was going to throw out. So I'm here to say there's 2 other things I want to talk about: accounting education and accountants in general. I think of the diagram in the integrated reporting framework. I call it the octopus diagram, the big diagram of the value creation process and the business model. I think accountants, before they even get into the debits and credits, need to have a fundamental paradigm shift mindset fix, so they understand what it is that they're going to be accounting for. And if they look at that diagram, sure, they'll see financial capital, and they've got some skills around how to deal with that. And there's some other kinds of capital, which is where the work has to go. So I think they have to have that. And I also think this is radical Copernican revolution thinking. I think accountants and many others need to understand, back to the planetary limits, that all of this brilliant business enterprise at the end of the day has to, has to deal with not only climate change, but all the other stuff we're doing to threaten the planet's, ability to support life. That sounds awfully wimpy and tree-hugging stuff, but the fact of the matter is, I do believe that's a scientific, physical reality. We just have this one planet, and we've got to fix it. So I think there's some radical things to do with the education system.
Well, thank you. Alan T.
Yeah, I think the thing as accountants, I think we are very good at providing information to help people make decisions. And I'd still anchor around that. I use a very simple example to illustrate what I think the issue is, in that if I buy some goods and I get an invoice, it tells me how much they cost. And we're really good at capturing those in our systems. But if that invoice also told us what the greenhouse gas emissions were created in making that piece of inventory, what sort of people were used in terms of their, for all we know that the workforce that was used to produce it has not been well paid, etc. If all that information came into it, then, and we synthesized it all, then people can understand the trade-offs between all of these different things. What you change your supplier because it's better for the climate, but it's going to have some financial implications potentially. We want to give information so people can actually make these sensible decisions and understand them. And I think it's as simple as that.
Wonderful. Jeff, I want to give you the last word. What will your graduate of the future look like?
Thanks. As one of the non-Allens on this, I appreciate being able to get the last word. I hope that the future graduates will be looked at as professionals who are not going to just be experts in whether business activities are related to being profit centers or cost centers, whether being experts around whether costs are fixed or variable, being masters of debits and credits per se. I hope that they're viewed as masters of business, in that they understand the business activities in the industries in which they work, and they understand what the resources are, what the dependencies are for creating value from those business activities as part of that. They understand what the impacts of those business activities are on the resources and dependencies. They can analyze the risks, the opportunities related to that, and they can help deliver on enterprise value. I hope that we ultimately, as accounting professionals, deliver on being the language of business. And it's really broader than just debits and credits. It's around what do businesses do and how do they create value from that.
Thank you so much. Gentlemen, I think we're out of time. Thank you very much for a very stimulating and interesting conversation.